And now, The Money Show with Motheo Khoaripe
on 702. Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025. Good evening and welcome to The Money Show on this Tuesday evening. My name is Motheo Khoaripe, in for Stephen Grootes. Thank you for joining us. We'll be talking about something that's going to be affecting all of us come the 1st of May. On tonight's show, we talk about the value-added tax U-turn, this time focusing on retailers, manufacturers, and other service providers who are in a scramble to make sure that they don't overcharge you come the 1st of May. We look at that complication with Zinhle Tyikwe, CEO of Consumer Goods Council of South Africa, just the cost of reversing such decisions. Then we look at the commodity that determines how much you'll pay to fill up your tank, and one that also plays a pivotal role in pricing the goods we buy. The oil sector has been really low as those oil prices are around that $60 mark. Since the pandemic, this is a record profits have been lost by major companies, including BP. Tonight, we'll be having that conversation with Manqoba Madinane, a strategist, fixed income, FX and commodities at Rand Merchant Bank, as well as Paul Gooden, portfolio manager at 91. We'll also zero in on the state energy supplier Eskom. It seems the battle to keep the lights on is being won so far. But what about the electricity company's debt and operations? Ruse Moleshe, energy expert, will talk to us about Eskom's plans to resume borrowing after current debt relief program ends, aiming to keep debt below 300 billion rand. We'll find out whether that is particularly possible for Eskom. Later, after 7, we'll have the Africa Business Focus. Dr. Rutendo Hidingwi, the founding director of Tribe Africa Advisory and author of Rumble in the Jungle Reloaded, will give us the top business news stories from around the world. We'll also have, of course, Warren Ingram, financial advisor and co-founder of Galileo Capital, joining us for personal inflation rate. What is a personal inflation rate? I'll be asking them that about later, and that and more on The Money Show. Let's talk money.
The Money Show with Motheo Khoaripe
on 702.
702.
Now, Parliament's Finance Committee has called off a meeting that was set for Wednesday to discuss a new bill that Finance Minister Inoko Dongwana introduced last week to reverse a proposed value-added tax increase on the 1st of May. The budget process will have to start from scratch after legal challenges by the Democratic Alliance and the Economic Freedom Fighters led to an out-of-court settlement suspending the planned 0.5 percentage point VAT increase. But as that chaos played out, retailers, service providers, and even manufacturers had been frantic trying to adjust their operations to the VAT increase. A sudden U-turn on the value-added tax increase left retailers, banks, and other businesses scrambling to make sure they don't overcharge you and I as consumers come the 1st of May. Zinhle Tyikwe, the CEO of the Consumer Goods Council, joining us for that story. Now, Zinhle, welcome to The Money Show. I mean, like many South Africans, have received 2 sets of SMSs from businesses. One informing us that VAT is going to be going up to 15.5%. And then a week later, another SMS telling us that it won't actually go up. How has this affected the business players in terms of changing that VAT to and fro?
Good evening, Motheo, to you and your listeners, and thank you for having us today, this evening. So definitely that has affected our retail and manufacturer members as well as quick service restaurant, because this is our mandate. Those are the individuals that we, or businesses that we represent. It has affected them because they had prepared. I mean, when it was passed by Parliament and when it was first announced by the Minister, businesses went into action to make sure that they are ready for the 1st of May. And then subsequent to that, we've seen playing out in court, as well as the Minister doing a public statement, an announcement saying now we're going back to 15%. There's cost involved in businesses when you do these system changes for compliance purposes and the like. So there's definitely cost that our members are now have to bear. And they have assured us that to say they're not going to pass that on to the consumers at the point of sale. Remember, the value chain that we are representing is from farm to fork, the whole of the food and non-food value chain and services from now quick service restaurants. I mean, those members had to change menus, prices. Now, some of them have printed menu prices. Now they have to incur those printing prices cost. So it's a huge cost, and these are the fundamental issues that we want government to understand when we are in an economy where we want to create employment, where we want to create certainty. These are not the principles that we should be abiding by, the way we not have any certainty that is to make sure that business thrives in South Africa.
Well, we look at the SMSs and think, they just popped me an SMS informing me about changes. But just how big is the undertaking of changing things like value-added tax?
It is big. But remember, there's compliance issues, it's tax issues, adhering to tax laws of the country, system updates, and it's not only just from the retailer's perspective at the point of sale, where they have to also do the price changes at the shelves and within their distribution and warehousing spaces, but also the manufacturers, they have to do the input cost that comes with manufacturing in any product. So the impact of value-added tax within the supply chain of food and non-food and services is huge, especially where there's a production aspect to it. Because when you produce food, there's a farm aspect to that, there's logistics aspect, there's distribution aspect, and then a production, and then it comes to the retail. So there's a whole value chain where that needs to be included before the price that actually we see at the point of sale. So, just besides the compliance and the systems update issues, these are all the other issues that we really need to be cognizant of.
And as the Consumer Goods Council of South Africa, have the businesses told you just how much they've been spending, firstly, to try and introduce a value-added tax, and also scrapping it and making sure that they reintroduce a 15%?
Our members are currently doing those calculations. They're going to share that information with us so that we can just do an average cost for the sector to say these are all the realities that we have to live by. And some of them, I'm sure over the weekend, there's reports some of our members have said, are they ready? Because, retailers and manufacturers, they are really compliant in terms of making sure from food safety, food nutrition, and availability of food, and the pricing. They really make sure that as South Africans, we are confident of whatever we buy and consume is safe and it's at the cheapest price possible. So competitive prices for basic food are a real issue for us, and VAT is a huge component of those prices. So our members have just reassured us to say, we will share this information, and we're going to have to put it in a consolidated perspective to say this is what we have seen as costing our members. But our biggest issue, I think we've seen the bill that the rates and monetary amounts and amendment revenue of law bill coming out, it has removed the zero-rated food products. And that's what we were really excited about as an industry, to say these food are going to be going a long way for already stretched consumers. It's going to assist them because the number of those healthy food options that we're promoting, healthy lifestyles. So that's what we were looking forward to say, this is what's going to go a long way. And now they have been removed. So we really want government to just reconsider that decision in particular while they're still going back in terms of the framework of VAT or tax in this country. And
if any consumer is overcharged on the 1st of May, be it by mistake, is there any recourse?
What SARS has said, number one, we went to our lawyers, because even before the reversal, we were not sure because it was still subject to care in court. So we went to our lawyers to get advice to say, what do we really do by the 1st of May? Our lawyers at the time, they said we have to go ahead with the 15.5. Now, subsequent to that, we went to lawyers again. They gave us a legal advice to say we need to go ahead with the 15% because even though it was a public announcement, now it is a legal case, and now there's a confirmation from court to say we need to stick to 15%. The lawyers have said we go ahead. Our members are going to be charging at 15%, and even though the bill has not been promulgated by Parliament, when it does get promulgated, it's going to be done retrospectively. So members have reassured us they're going to be charging 15%. They're going to get ready their systems to be ready for 15%. If an incident, a system error of such a nature happen, we, like similar to what the commissioner said, consumers need to be really vigilant when they get their receipts to check what was charged, because it's going to be at the point of sale.
Okay.
A change or a difference that could happen would be at the shelf if they haven't been able to remove all the prices, and so that could be the only other change or differences that could be faced.
So just be vigilant on the 1st of May then.
Yes.
All right, that was Zinhle Tyikwe, CEO of Consumer Goods Council of South Africa, giving us the implication of that VAT U-turn for retailers. In the meantime, the National Treasury will host a media briefing at the GCIS Media Center to explain the technical process that must now be undertaken regarding the 2025 budget. The briefing will be led by Finance Minister Inoko Dongwana and Deputy Ministers Masondo and Sarupen, joining him for that tomorrow.
702 and Cape Talk.
Motheo is on X.
At Motheo_Khoaripe.
One story that caught my attention today was the BP story, the oil giant reporting deeper than expected 48% drop in net profit to $1.4 billion on weaker gas trading and refining results. The CEO, Murray Auchincloss, says following the introduction of global tariffs and related government responses, there has been increased market volatility driven by rising concerns around the potential impact of a weaker economic outlook. Let's look now at the sector and how it's been affected by that lower oil price. Manqoba Madinane, Strategist, fixed income, FX and commodities at Rand Merchant Bank, joining us for that conversation. Manqoba, as motorists and people that are looking for good prices, and we know how much those are affected by the oil price, seeing it at that $60-odd mark would have made some consumers happy, paying less for petrol. But for the global economy, what does it mean to have these big profit losses by the major oil producers?
Good evening, Motheo, and the listener. Sorry. It's certainly. I mean, we can almost see the oil price as sort of like a bellwether, right, of the world economy. So weaker prices obviously do mean that the economy globally is weakening, but there's bigger factors that are at play on the supply side here. So the key circular factor that is at now play is what OPEC Plus has agreed to do, and that's ramping up previously mothballed oil output. So the single biggest reason for the past 2 years or so why oil has traded around that like 70 mark for quite a while before this recent move lower is that OPEC Plus was holding back on those supplies. So now they've agreed from May to ramp up at a much faster pace than what they had guided. So that's the primary factor that's at play, but of course we've also had this market volatility that's just added to the downforce.
Tell us what an increase in production will mean then for the price of oil on the global market.
Just to put it into context, I mean, so this holdback that OPEC Plus had instituted all the way from July last year, they've been holding back, had the global market in a deficit, right? So that basically means that in real terms there was a shortage. So now this increase, which is at a pace of 411,000 barrels per day, compared to guidance of around 140,000 barrels per day, now basically means that there will suddenly be a surplus, and that's the reason why, as a house, we believe that oil prices now will shift lower on a structural basis. So we think that the $60 environment will be with us for quite a while.
And then looking at other factors now that may hit the industry, we've seen the BPCO coming out to say, what we're seeing between the US and China in terms of trade tensions, but also the higher tariffs that we've seen over the past month. have really hampered demand in that particular sector. How do you see it play out for the major oil producers? Because, there was a time where they were doing well, the oil price well over $100, but now finding themselves in great losses.
Yeah, look, I think we need to classify. So from a mining point of view, right, the key thing to think of is whatever business you are in, if the costs of you doing whatever you need to do is lower than the revenue flow, it makes sense. So we're not at a point where the global oil industry is unviable. So at a marginal cost basis, there is obviously a regime change in the sense that it's much lower market prices, but marginal costs globally are still below the 50 mark. So technically, even the higher cost reserves right now, they are making money, but of course, there's a much larger squeeze to how much they are making. So the profits are dropping, but at an operating level, the global oil industry remains viable. And in fact, there's actually quite a longer-term risk I'm worried about.
Manqoba, I want to bring in Paul Gooden here, I want to bring him in on that point. Paul Gooden, of course, our portfolio manager at 91. Looking at the sector right now as it is, with all the geopolitical factors that may be affecting the oil price, but also the moves from OPEC Plus, where do you see that oil price hitting later this year?
I agree with pretty much everything your former contributor said, actually. I think he's exactly right. And look, the oil price averaged $80 last year. It was $80 in January. Here we are at 64. I agree that the market looks oversupplied for the next 6 to 9 months. So I likewise see oil prices drifting a little bit lower. The question is, how low can they go? And the marginal supplier globally is the US shale sector. US shale needs about $60 break evens. And, most of the big US shale companies are on kind of like big annual programs. They don't like to ramp up and ramp down partway through the year. So, look, I think you'll need to see, Brent prices fall into probably the mid-50s. And at that level, I think you'll see US shale production start to go down with a lag, but probably start declining by maybe 1 million barrels a day annually. And that is a significant enough decline for the market to balance. And you have to remember with commodities that the cure for low prices is low prices. And so, I think probably mid-50s Brent is probably a level to think about as being a good support level.
All that does Paul Gooden, portfolio manager at 91, joined by Manqoba Madinane, strategist at Rand Merchant Bank.
The Money Show.
The markets.
Let's cover the markets now, looking at those numbers that came through from the JSE after that holiday. Ryan Hill, head of fundamental sales at Absa CIB, joins me now. Looking at the market liquidity, was it very light to start off after that holiday period?
Even Motheo, indeed it was. Volumes came in at about 20 billion rand. Normally we were closer to 40 billion rand in these last couple of weeks. But no surprises, of course. I think many have opted to take extended leave given the number of public holidays we've had recently. So not surprising to see volumes somewhat light.
Does the JSE like that? These holidays back and forth, back to back?
I think it leads to a tougher environment in the sense that liquidity is lower. And as a consequence, you can have somewhat exaggerated moves as far as share prices are concerned, given that there's just not enough participants in the market at the time.
A big jump for the telecoms giant MTN today, backed by results elsewhere on the continent from Ghana. That business looking at least to be having some positive numbers, especially closer to West Africa.
Yeah, indeed. So look, basically those numbers came in even better than we were forecasting. You continue to see very strong momentum in the data space as well as in the mobile money space. So I think we will probably have investors continuing to expect upside as far as the other regions are concerned as well. And as you say, MTN closed up something like 3% today as a consequence of that.
Banks are also good, up 1.5% today. A big rebound for them after the break.
Yeah, indeed. So I was looking at the overall markets today. If you look at the top 40, it basically hit a new record high today and came in at about 84,000. Now that's pretty much up 11% year to date. But what that disguises is the fact that between the 1st and the 4th of April, you had a 9% drop in the market as a whole because, of course, of all the machinations around Trump and the to and fro as far as tariffs are concerned. Since then, interestingly, we've seen something like a 12% rebound in the top 40. And largely that's been driven by the gold stocks, which are up something like between, call it 10 and 14%. The banks, which are up 16%. And then the retailers as well. There's been a fair amount of, should we call it bargain basement hunting there. So the retailers are up 17% as well. So yes, market certainly looking buoyant at the moment.
And before we let you go, the effects of the Trump presidency and a big week for them in the US on the markets, tell us how that could likely play out.
Well, we've got a fair number of major tech companies reporting earnings this week. So that's Apple, Amazon, Alphabet, and so on. And I do think the market, given the fact that it's taken its steer from the Magnificent Seven during the course of the last couple of months, I think that'll continue post this results season. So, you know, it will be important to set the direction and tone for the market from here on out. Of course, time will tell quite how the tariffs discussion turns out. And that could introduce further volatility into markets for the next couple of months as well.
Well, buckle up, more volatility there. Ryan Hill, the head of fundamental sales at Absa CIB, joining us for our markets commentary tonight.
You're with Motheo Khoaripe on 702 and Cape Talk.
Welcome back to The Money Show. Let's talk about keeping the lights on in the country and making sure that Eskom is a viable state entity. Talking to Grootes Muleshe, energy expert, about Eskom's debt management plans. Now, the power utility Eskom saying it's ready to resume its borrowing program once the current government debt relief program of 254 billion rand, which came in with a ban on new borrowings, has run its course at the end of its current financial year. Of course, Treasury handing over that particular program in February of 2023. It comes to an end in this financial year, and Eskom saying it's ready to go to the rest of the market. Grootes Muleshe joins me now. Grootes, we've looked at the ability of Eskom to keep the lights on, making sure we don't have much load shedding, but just zeroing in on the numbers and its debt issues. Are you comfortable that we are seeing as an Eskom that's turned over a new leaf and can handle its finances?
Thank you for the opportunity. Yes, partly Eskom, definitely they've done a lot of work to be able to try and turn around the institution. Firstly, in terms of load shedding, we are nowhere near where we were in the past, though we are not out of the woods yet. And in terms of the first time looking at profitability since 2017, that's also a plus. Obviously, that's partly thanks to the support that they enjoyed coming from National Treasury through the debt relief, and Eskom on their part meeting those conditions. Yes. So yes, we are on the right track, but there are long-term sustainability issues that relate to municipal debt, for instance. That's still something that's lingering.
Last week, the National Treasury saying it was confident that Eskom has improved its financial situation after receiving that 3-year bailout of 254 billion rand in 2023. During the meeting with the Standing Committee on Appropriations, Treasury noting that Eskom has effectively used the funds, alleviating concerns about its financial stability. So that definitely a good thing. But also Eskom saying it plans to keep its borrowings below the limit of 300 billion rand. So also speaking to a tightening of measures there at the state power utility.
Yes, definitely. And one of the biggest contributions is the improvement in the energy availability factor, which means that the plants that are available to generate electricity, some improvement in terms of customers as a result, as well as that once you improve performance, that means you spend less on diesel. And Eskom has done a lot of work to try and arrest that situation. So if they continue on that trajectory, that bodes well for Eskom's sustainability going forward.
Let's speak then about the money generation side, which could help them keep those borrowings at 300 billion if they can make more instead of always having to go and borrow. It's profit before tax for the December 2024 period was at a loss of 10 billion rand in the previous corresponding period to a 34 billion rand profit in December of 2024. And outstanding securities and borrowings are reduced from 439 billion to 409 billion. If they can get those revenues up, what avenues should they be looking at?
So if they get, firstly, if Eskom's availability of plants, meaning from an operations point of view, they are more efficient, meaning using the plants without load shedding and a lot of diesel, that would be a good thing. And then if they continue to increase in terms of customers, that they remember that when there's load shedding, then there's less demand and Eskom makes relatively less money. So if they can improve that, that will also or continue to improve that. That will also bode well for Eskom going forward. As I said earlier on, the lingering thing in my mind is just the municipal debt that seems to be getting out of hand with respect to Eskom, because it's one thing to increase your sales, it's another thing to not be able to collect those revenues or turn them into revenues that come back to Eskom. So that is the part that they are working very hard on together with the presidency, with many interventions to see how they can affect that. Because in the long term, it will not be such. Eskom may be affected negatively.
Yeah, I mean, about 10 municipalities honoring their accounts to Eskom, 100 billion rand in debt from municipalities. That definitely hits their bottom line. But are we closer to a time where we're going to see a good financial year for Eskom, where things like debt are actually lower and things like revenues and profits are higher? I know it's at the expense of us using the electricity in terms of tariffs, but it would be good to see the state utility in a good financial position.
Yes, for instance, they are now forecasting a 10 billion profit, which they have not seen profit since 2017. So that is good news for the 2024-2025 financial year. So that is already showing that there are improvements, and if Eskom continues in the trajectory they are going, we can expect a better performance. Remember that even from a tariff perspective, they were given relatively far less than they expected. But the just over 12% increase that they were provided also will assist in that regard.
Are we seeing an Eskom that's being led well enough for the market to be open to borrow it money? Because I'm sure there would have been a concern about its ability to repay, given those debts we've talked about in terms of municipalities, but also the way it was being run. Is there now renewed confidence now that we don't have constant load shedding in the country and that a new team is at the helm?
I think there might be an appetite for Eskom in the market, but they probably have to be very creative in terms of, for instance, the projects that they have on the pipeline, gas to power projects. I don't see them going on their own in terms of that. So looking at partnerships and trying to leverage financing from other entities will be a creative way in terms of which Eskom can make some of these transactions they are looking at bankable. So there's a lot of work that needs to be done. Yes, there's confidence, but there needs to be a lot more building, and they need to find partners that are even more bankable than they are, to be able to put themselves in the market for financiers to say, yes, we think Eskom can deliver on these projects. But yeah, the work they've done so far does bode well.
How tough does that debt make it for Eskom in terms of also capital expenditure, in terms of new projects, making sure there's new generation, especially with a grid that's ever increasing in South Africa? I know Eskom plans to spend around 140 billion rand to fund new gas and renewable energy projects, but they still have this debt hanging over their head.
Yes, I mean they're trying to keep the debt below a threshold so that it's not it doesn't become a deterrent for financiers in the market. And I think, as I said earlier on, if they try to leverage some resources within the market where they request, they partner with other entities so that they require relatively less debt, that would even be better for Eskom. So yeah.
All right, thank you for that analysis there, Grootes Moleshe, energy expert, talking to us about Eskom's debt problem and the fact that they're going back to the borrowing market after being lended a hand by National Treasury in February of 2023.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.
Well, if you're like me and you've been feeling a little poorer these days, you're not imagining it. South Africa's salary earners are taking home slightly less in March of 2025, reflecting the growing pressure on the economy from both domestic and global developments. The cost of living crisis continues to squeeze South Africans, with data from the latest Banks of Africa take-home pay index showing life became more and more expensive for salaried earners in South Africa. According to that data, average nominal take-home pay slipped to 17,811 Rand, down 2.5% from February's 18,272 Rand, though still 11.4% higher than a year ago. Joining for this conversation is Elise Kroeger, independent economist. Elise, looking at the economy in South Africa, the inflation that has eaten away at our salaries, and the realization that life is really tough, down to what happens in our wallets and purses.
Indeed, Motheo, we've seen over time, or actually last year, the Banks of Africa take-home pay index has been on a rise. Really a positive development at that point in time, but we have seen that slipping in the month of March, as you mentioned, and I think that has a lot to do with the fact that we are seeing somewhat of a U-turn in our economic prospects for 2025. We have started off quite positively at the beginning of the year, hoping to see an economic growth rate in the order of 1.7% for 2025. And now, with all the risks playing out globally with the trade war, and we've had a bit of a turnaround in confidence in South Africa, given all our own political troubles around our budget and, a bit of a dent in confidence there. We're starting to see that we, had to cut our growth rates for South Africa this year as well.
And what is that number now in terms of that revision?
Yes, so I've sliced my growth forecast by 0.5 percentage points. So I now forecast a 1% real growth for 2025, which is just a bit above last year. Last year's 0.7%, if I'm now right, and the previous year 0.6, in that order. So, it shows that we remain in a low growth profile, that we are just muddling along at this fairly low growth, without really being able to get enough momentum to break out of that. At the beginning of this year, my thoughts were that the cyclical tailwinds coming from the lower inflation environment into 2025, and also the cuts we had in interest rates, the real wage that has opened up since 2024, that all of those in combination would start to push the economy forward more robustly to this type of 1.7% growth rate. But unfortunately, since then, we've had the evolving global trade war, which is not only negative directly on South Africa per se, given a fairly small exposure directly to the US in terms of our exports, but more so a negative indirect effect via our trading partners in the rest of the globe that will also suffer in this global trade war. So reduced demand for our exports coming from lower global GDP growth. We've had some pressure on the rand exchange rate, some risk aversion, higher risk premium attached to an investment in South Africa. All of those factors adding together is quite a negative, impact in this current year.
Now, this particular take-home pay index looks at the salaries of 4 million earners in South Africa. One would have thought the lower inflation that we're now experiencing would have, played a better part in making sure that the rands in our hands are of more value. How do you see it playing out for the rest of the year, especially with the volatility brought on by the higher tariffs from the US?
Yes, actually, I just want to maybe give a bit of perspective, if you say that, especially referring to the inflation rate. If you look at the take-home pay in real terms, although a slight dip in the month of March, for the first 3 months of this year, in real terms, take-home pay is still up by 10.5%. So the lower inflation environment has indeed impacted positively, especially on the real take-home pay. So from that point of view, a salary earner should experience a bit more purchasing power in its pocket compared to a year ago. And I do think we're going to continue to see that inflation remain quite moderate into 2025. Because on the one hand, as much as you think about the import tariffs going to be inflationary globally, if you also think about the indirect effect on global demand being a depressing effect, we're looking now at an oil price that is likely to average around $65 per barrel in 2025. Actually, just today, the World Bank has released their latest commodity outlook, and they've actually put it at 64 for this year and 60 for next year. So now you're looking at South Africa, which is a big importer of oil, and it's a very important determinant of our fuel prices. And you look at the rand exchange rate, that yes, it did blow out in the initial reaction to the trade war, but it has come back. And we actually could see drops in our fuel prices in the next few months, and that will offset some of the other negative impacts.
And I'm sure another positive will be the proposed value-added tax increase being scrapped. That should give us a bit of relief on our salaries. Elise Kruger, the independent economist, speaking to us about South Africa's take-home pay, currently feeling a little bit poorer, but the South African consumer should be good towards the end of the year.
And now, The Money Show with Motheo Khoaripe
on 702. Let's walk the talk.
Just after 7, welcome back to The Money Show. It's quite hard to touch on any business story these days that has not been affected by the Trump presidency. The South African agriculture has significantly benefited from the African Growth and Opportunity Act, that being AGOA, the preferential trade agreement that we have with the US, earning over $7 billion or 125 billion rand in agricultural exports to the US since its inception. About 2/3 of South Africa's agricultural exports to the US are exported tariff-free under AGOA, so something we've enjoyed quite keenly as a country. And now we'll be going into a conversation with Nkosinathi Mahlangu, Momentum's Youth Employment Portfolio Head, about the effects of losing some of these relationships and also the higher US tariffs.
The Money Show with Motheo Khoaripe
on 702.
702.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025. Let's get into this conversation now with Nkosinathi. Nkosinathi, welcome to The Money Show. A lot of uncertainty around South Africa's AGOA contract with the US preferential trade agreement that, of course, plays out in the economy, helping those that are, producing wine, producing cars for the U.S. market, but also South Africa's farmers that produce produce that heads to the U.S. Looking at the situation now and how volatile the situation is with the Trump administration, how could this affect the rural players, the farmers in the country, if it goes sour?
Thank you very much, Motheo, and good evening to you and the listeners. It is it is a very serious and a concern for South African farmers, especially when we're looking at the smallholder farmers, those who are in rural areas who are still trying to break into the market access space. And looking at the duty-free access that South Africa and many others used to enjoy through the AGOA, once that is taken away, it will also pose another challenge in terms of who will these farmers grow their produce for? Because now this means they will have to tap into new markets and compete with already existing suppliers in that space, which can be detrimental for their businesses and the sector at large.
Now, tapping into other markets is not as easy. We have seen the citrus players in the country battling to get their produce to the likes of Spain and the rest of Europe because the restrictions there, the red tape and some of the regulations that change as and when it happens affect, the amount of produce we take to Europe. So America has been quite a good market for our citrus and avocado planters.
Most definitely, Motheo. I mean, looking at the benefits that the American market, brought to the exporting duties of South African agriculture, looking at what AGOA itself meant to smallholder farmers and those who are also, playing a role in making sure that they also, create jobs in terms of making sure that there are employment opportunities created locally while they export the fresh produce abroad. Now, looking in terms of what this means now moving forward, we know that it seems like we won't be enjoying the duty-free access going forward, and the 10% tariff that is subsequently going to be 30% or even more. This is a major setback. Now, it also requires us as South Africans, whether it's a public sector or the private sector, looking into the agri space and saying what other opportunities can we derive from within in order to mitigate this gap that will be created by this big shift.
Now, it's not easy replacing a market or finding a new one outside of the US, because currently we're tied to AGOA, that particular contract, but also the US is South Africa's 6th largest market for agricultural products. If you think about citrus fruits, wine, nuts, those the leading exports, with citrus remaining the key driver. How do we make sure then that we prepare for a situation where we are without AGOA, but also support the farmers enough so those jobs aren't lost?
That's a very important question, Motheo, because, what we've learned over the years in agriculture since, the beginning of time is that agriculture is surrounded by factors, external factors that are beyond the farmer's control. And this type of a factor that we're discussing now is not even a weather-related factor. However, this is more of an economical scale. And now we have to look at ways in terms of how do we now start maybe making proactive measures, even though there won't be as, when you look at the monetary value, there won't be anything close to what AGOA meant to us or AGOA means to us. However, looking now in terms of where else can we trade as South African farmers, are we going to pursue maybe intercontinental trade across Africa to see what other fresh produce that would come from South Africa to our neighboring countries or any other African state, and while also tapping into the BRICS community to see what other opportunities can be derived from that type of partnership. So this definitely requires us now to put our thinking heads in terms of how do we make sure that we bridge the gap that will be left by AGOA. However, trying to also come up with strategies that speaks to preferential procurement to see how we can also have some form of policies, a policy shift to support emerging farmers and those in rural areas.
Now, the numbers are huge. I mean, in 2024, for example, roughly 8% of oranges worth 14.6 billion rand, 11% of mandarins worth 10.5 billion, and 27% worth of macadamias worth 2.4 billion rand were sent to the United States. A big market there. Is there a situation where we should see the Trade and Industry Department looking for markets locally around the SADC region where we can have more consumption of those numbers, or are those numbers just too big that we'd have to look for a market like Asia, for instance, where these could be consumed?
I think even though those numbers are too big, Motheo, we still have an opportunity here to say, while we look elsewhere, we also need to revisit the discussions with the U.S. as the current, fresh produce, one of the fresh produce providers to the U.S. to say, now that with the tariff shift, what does this mean to the trading relations in as far as those commodities, especially when you look at the Macedonian and the citrus produce, to say what would the picture look like once those tariffs are being put into action, and what does it mean for exporting duties now? How much will that cost? And then while we're looking elsewhere, we can see what maybe the gap, how big of a gap that would be, so that we don't only put our eggs in one basket, so to speak. However, try to diversify in terms of where else can we go and explore and break into markets, even though it's not going to be as easy as we put it. However, those ongoing discussions, especially with the Department of Trade and Industry, to say, while we have an already existing relationship with the US, how do we mitigate and salvage that relationship moving forward, bearing in mind the shift that will happen in as far as tariffs are concerned?
Perhaps the other option then, while we still negotiate the contract with the US, because of course US citizens also have to eat, so it's not a situation where if we don't see eye to eye at the table, the relationship will be cut. I'm sure there'll still be some negotiation that happens. But while that happens, isn't it not the onus on the South African government to try and look at the value chain and say the amount of oranges we send to the US, some of them should be turned into juice, into other products that are viable for other markets, so that we don't only rely on the produce we've produced, but we also make, products coming from those oranges, those macadamias.
Most definitely, Motheo, that is the direction in which we need to start thinking. And this type of thinking and proactive way needs to happen where we also involve the role players in the sector as well, so that it doesn't come across as a government initiative alone. However, this needs to be a collaborative approach whereby now we see the role players in the agri-sector saying this is what can possibly be done in as far as, diversification or maybe expanding into other markets where we wouldn't necessarily be trading directly at this point in time. However, looking now also inwards and saying the SADC region, who is supplying what to who? Let's also, make sure that those relationships are being put to a point whereby we could see how we can create some form of a win-win situation. And with South Africa also having, a seat at the table when it comes to BRICS, this also opens another opportunity to say we produce this amount of produce that we can export to these markets, and also making sure that we also look in terms of what the benefits thereof in as far as trade-offs. What are we getting in return? Can we still retain the jobs that we have locally in the sector and still grow the markets that we're trying to explore within the continent and abroad?
Another key option then would be the Africa Continental Free Trade Area. That particular agreement coming into effect, of course, in 2021, creating a market of 1.2 billion people. So that's a big market. I mean, if the African nations come together, all 55 member states of the African Union sit and say, okay, let's try really trading amongst each other, because as we can see, the world is quite volatile now, and for the only way our continent can survive is if we provide the market that we so seek from the West. That could be a possible long-term and sustainable answer.
Most definitely, and it's an idea that has been thrown around for quite some time, and it could also mean some cost-effective ways of transporting these fresh produce across the borders. As when we are trading within the continent, it makes it easier logistically as well, which will have a ripple effect in terms of how does it affect the bottom line. So in terms of free Africa trade opportunity, I think now it is the right time for us to now start putting some action into those ideas in terms of where do we start and how would success look like in that regard. As looking at how we are positioned geographically, we do have unfavorable weather conditions at this point in time. However, our agri sector has been very much resilient in terms of making sure that there is food security, but over and above that, we can still trade with our counterparts abroad and locally.
Nkosinathi Mahlangu, thank you so much for your contributions. Nkosinathi Mahlangu, Momentum's Youth Employment Portfolio Head, looking at the permutations that could come from losing that AGOA contract or, preferential trade agreement with the U.S. is also how U.S. tariffs are likely to affect local farmers in South Africa.
You're with Motheo Khoaripe on 702 and Cape Talk.
And as we do every Tuesday, we have the Africa Business Focus, looking then at the rest of the continent and what exactly is happening when it comes to exchanging money. Dr. Rutendo Hidwingwi, a founding director at Tribe Africa Advisory and author of Rumble in the Jungle Reloaded, joining us for that this evening. Rutendo, looking at the IMF weighing in again on the continent, I have a love and hate relationship with the IMF and some of the controls they have as soon as they borrow a country money. But let's get into what they say Africa must prioritize in terms of the private sector.
The Bible says he who borrows is always slave to the lender. I didn't say that. So, in biblical context. Always good to chat to you, Motheo. It's been a long time. Since I think the last time we chatted, the VAT was 15.0 in South Africa. But let's not.
I'm happy it remains that way. The more things change, the more they stay the same.
Very true. So just coming back in terms of the IMF, obviously there's a big conference happening, or that happened last week in the US with all the finance ministers meeting, and on the sidelines, some of the key discussions that came there was that IMF highlighted that there needs to be sort of a focus that has to happen with regards to the private sector taking a more lead role with regards to turning the opportunities in Africa for allowing for economic growth. And this was one of the sideline points that came out. Some countries that were sort of highlighted as making sort of economic structural adjustments to align with this with Tanzania and Senegal, and Angola and Nigeria obviously taking a bit of a knock with regards to their reliance on oil. But just some key points that came out of that. I mean, the IMF highlighted that GDP growth in Africa is to grow from 3.8% in 2025 to 4.2%. And this is going to obviously overcome challenges raised by price pressures, as well as the application of tighter monetary and fiscal pressures in order to achieve this. Another key thing which we've always known is that the youth population and the demographics play to our advantage because they see this as a source of investment and consumption. I mean, the median age in Africa is 18. The global median age, especially in developed countries, Motheo, is but plus or minus 30 years. So we've got that advantage to our side. But all in all, I think with Trump 2.0, what happened was that with the tariffs and the protectionist as well as the unilateral moves that he did from a global trade perspective, there was a lot of assets that were sold in risky markets such as in Africa. So they are saying the private sector has to step up and work with the public sector, obviously. I think that the issue of loans and the implications will always be a challenge, but that was some of the key highlights from the IMF at the sidelines of the big conference that happened in Washington last week.
And I'm sure that one of the major concerns will continue to be some of Africa's largest economies are the ones lagging behind, even with that 3.8% GDP for the sub-Saharan Africa region. The main players in the continental economies are still quite low, looking at Nigeria and South Africa, amongst others.
No, that's true. I think, and that is always, but I think the challenge that you have, I mean, even if you look at a big economy like the US, which is 30% of global GDP and 10 times the size of Africa's combined GDP, its year-on-year growth is small. But that 1% or 2% that it doesn't does grow by, always makes a huge impact. And I think the reality for Africa is, and that's why things like the AfCFTA are absolutely critical in terms of you need to start strengthening other smaller countries, especially in an economy like Africa, to complement the bigger economy. So there's not a reliance on the big four or the big five, which is Ethiopia, Nigeria, South Africa, and Algeria. And I'm forgetting the fifth one. That's it. Those big top five. So there's a big reliance on those, and that's why tools like the AfCFTA should start creating other stronger economies to complement this, so that there's not one reliance on one economy or two or three economies on the continent.
I've just spoken about the African Continental Free Trade Area, but the second story you're looking at is around the Malawi-Tanzania trade row escalating. Of course, we're looking at trade amongst African countries, but when you're finding that agricultural imports from Malawi and South Africa were banned in Tanzania, it's not good news.
Yeah, it is not. I mean, we look at the trade war caused by America and China and all that's happening there. Then maybe Malawi and Tanzania said, look, guys, we might be a small GDP. I mean, the average GDP between them is probably 50 billion, which is small in the bigger context of things. And they have also said, look, let's have our little war. But the tiff that is there is the total trade value between Malawi and Tanzania is probably about 253 million US dollars. And about 177 of that is trade surplus to Tanzania. And the big argument is around the retaliation by Tanzania for Malawi blocking products such as flour, rice, ginger, bananas, and maize. And one of the big exports from Malawi to Tanzania is bananas. And obviously, the trade ministries are both talking about negotiation around it. I think in the bigger picture of things, they don't need this. In a time where Africa has to unite from an economic perspective and political perspective. I have arguments, but not to the point that people suffer. There's an African proverb that says, when elephants fight, it's the grass that suffers. And the biggest negative impact that's happening here is on the SME farmers and shoppers who work between Malawi and Tanzania. And it's something that can be resolved. It's obviously escalated also to South Africa with another dimension. But at the end of the day, it doesn't bode well for that regional economy when so much more energy and focus can be put elsewhere.
And to be fair to Tanzania, I mean, South Africa had blocked Tanzanian bananas coming into our market, but this is not a time for countries on the continent to be protectionist, especially with what's going on around the world. Then Africa policymakers urged to boost data security. Kaspersky coming out to say the 14% spike in spyware attack detections on businesses in the African region, a great concern.
Yeah, so you bear in mind that IT penetration as a show of technology growth in Africa is on average 52%, and the global average is 17%. So technology playing a great role in terms of Africa's development. The spyware has gone up by 14% in terms of attacks with regards to IT infrastructure on the African continent from 2023 to 2024. That's quite significant. Another scary thing which contributes negatively to this is that, and I didn't know this, Motheo, is that 2% of data produced on the continent is hosted on the continent. The rest of the 98% of the data, of African data, is actually hosted externally.
So an infrastructure question there as well.
It's but an infrastructure. That's why the role of data centers are absolutely critical with regards to investment of the continent. And more importantly, we have this saying that we say that, data is gold, or is a big asset. So if we are only hosting 2% of Africa's data, that means somebody else is looking after our gold, which is our wealth. So, but at the end of the day, from a risk perspective, it's huge. And but the good thing, though, is that 36 out of 54 African countries have data protection laws, including South Africa, which is the POPIA Act, and Kenya, which is the Data Protection Act. So there's still a long way to go, at least we're making significant inroads in terms of doing that. But it was a big concern that was highlighted at one of the big conferences that happened in Africa with regards to technology, infrastructure, and data risk.
I mean, off the top of my mind, I'm remembering MTN and I think Standard Bank having recent data breaches and cyber attacks. So I think it's also the corporates on the continent that should be coming together and making sure that we have, even if it's a shared, infrastructure in terms of making sure our data is secure. Then Equatorial Guinea's secures investment grade rating. How good is that for them?
Yeah, usually Equatorial Guinea has had a lot of, has been out there in the wrong terms of noise. But with regards to Bloomfield, which is the investment grading firm, they've been given the BBBA2 ranking with regards to investment. So they're trying to move away from relying on oil. They've got a small GDP of 12 billion, but a huge portion of their reliance is on oil, and they're trying to diversify from this. I think they did about 2.84 billion in 1 year just out of revenues from oil. But their public spend remains under 37% to GDP, which is great. But ultimately, they're showing all the right indicators with regards to investment and attracting investment into the country and taking them forward, obviously coupled by political leadership, which is key.
That was Dr. Rutendo Hwindwingwi, founding director at Tribe Africa Advisory and author of A Rumble in the Jungle Reloaded, looking at our Africa Business Focus feature.
The Money Show.
Personal Finance with Warren Ingram.
20 minutes now to 8, and we're going to get into our personal finance feature with Warren Ingram, the co-founder of Galileo Capital, talking to us about your personal inflation rate and why it matters. Now, most of us will keep track of CPI, looking at the prices of goods and services. But how much do you keep track of your personal inflation rate? Warren, welcome again to the Money Show, and thanks for joining us this evening.
Thanks so much, Motheo. It's good to chat to you.
When we talk about a personal inflation rate, what exactly are we talking about?
We're talking about how, you know, my cost of living changes from 1 year to the next, how your cost of living changes, and it is a very different number to that CPI number that we often hear about on the radio. You know, we'll often hear the, you know, Stats SA or the Reserve Bank will say, you know, CPI. I know they put out a number recently saying that CPI has dropped to 2.7%. And I don't know about you, but when I look at my cost of living and I talk to my friends and the like, we kind of say to ourselves, well, hang on, you know, my cost of living is not only going up by 2.7%, it feels a heck of a lot more.
Yeah, you're not feeling the love.
Yeah, I don't know who these magical people are whose cost of living is only going up by 2.7, but it's not me. And so I think a lot of people feel the same. And actually, I mean, to not make a joke of it, but some people even think it's kind of a conspiracy that Stats SA or the Reserve Bank or somebody's lying about the number. And so maybe just to break up the difference. So the CPI number is a national average. In other words, it's a basket of goods that the economists have decided on, and they say we're going to put certain food items into this basket of goods that are most typical for most South Africans. We're going to put the cost of fuel in there. We're going to put some form of a cost of housing, et cetera, et cetera. And then they come up with a number, and then they measure that number and how it changes from 1 year to the next. And we need to understand an average is a funny thing because, you know, your feet could be in the fire and your head could be in the freezer, and then the middle of your body is an average temperature. And then you might say, well, I'm not fine at all because, you know, my feet and my head are in trouble, but on average, my temperature is fine. And that's the same with an average. An average, you know, can hide a lot of different things. So when we look at our personal inflation rate, what we're actually looking at is how does like my basket of goods change from 1 year to the next? So the food that I'm buying, you know, is it certainly more or less expensive than what the national average was? And, you know, for a lot of people, you might find transport is a bigger portion of their costs than the national average. And so if fuel is going up quickly, then their cost of living actually might be accelerating a lot faster than someone who maybe lives, you know, in a place where they don't travel at all. And they might find that their cost of living is accelerating more slowly. And the same if you grow your own food or you're relatively healthy and you're not spending on healthcare, which might be accelerating. So each of us has an individual cost of living, and it's by no means meant to look exactly the same as that CPI number that we always hear about.
So apart from the national average, you're saying we should still do the homework of making sure that on a case basis in our personal lives, we know how we are affected by inflation. For instance, somebody who has a longer commute to and from work will obviously spend a lot more on fuel, so they'll be affected by any fuel increases in terms of inflation. And those that, you know, are living off their own gardens sometimes and buying and not necessarily buying vegetables, but just picking them from their own garden would be less affected by price increases in terms of food.
Exactly right. And also, inflation, I mean, not to try and get too kind of technical, but inflation is a measure of change. So it's not, when people say, I see the CPI might only be at 2.7% up now, but my food prices haven't come down. Well, that's true, because in order for food prices to come down, you would actually have to see inflation go minus. It would have to be a negative number. And that almost never happens. If food prices go up, they tend to stay at a level, and then they might not go up much faster in the next few months or next year or two. And so there are certain parts of our spending that can be quite stable and quite static sometimes, but the one that's incredibly volatile would then be the price of fuel, because there are two things that impact the price of fuel. One is the exchange rate, because unfortunately we pay for our fuel as a country. We buy fuel and we pay in dollars for that. So when the rand goes from 18 to the dollar to 20 to the dollar, that means that our fuel has gone a lot more expensive. And then the second thing is that fuel itself is a volatile price, and it is priced in dollars, and it can go from $50 to $70 in a very short space of time. And then, you add that to the exchange rate, and fuel can be a very volatile thing. So there is a chance that we could see fuel prices come down, and that helps a lot with getting inflation to slow down. But unfortunately, things like rent or cost of housing and as I mentioned around food, those tend to flatten out sometimes, but I wish they would, but we don't see them going down unless you own certain properties in certain cities in South Africa.
Yeah, look, whenever food prices go up, I know it's unlikely they'll ever go down. You'll probably get a sale of here and there, but even that is not enough. So if I'm getting your explanation correctly, it's quite possible for your personal inflation rate to be higher than the national average then, depending on what you're affected by.
Yeah, and depending on your income level, and your standard of living, if you used a great example, if you're growing your own food and potentially you don't spend much on travel, then there is a possibility that you operate below the national average. But if you buy a high degree of imported items, you spend a lot of money on food that comes in packets, and lots of takeaways and those kinds of things, and then you tend to travel, either by public transport or on your own, and you do long distances every day, then the likelihood is that your cost of living might be a lot higher than the national average, and it is an important thing. I mean, it might just sound like a school lesson now to say, your personal inflation is different to everyone else's, and that's not the end of the story. Your personal inflation rate really matters to your long-term financial planning. It is something we really should pay attention to.
Then what kind of metric should we be using to measure our own personal inflation rate, and how important is it to know those numbers, maybe on a quarter-on-quarter basis?
I feel like we probably don't need to do it every single month. I mean, I know there are some people out there that love spreadsheets and love tracking things, to the last cent. And if you really want to and it excites you to do it, then by all means track your expenses, every month and see how it changes from month to month. But I think, most of us, we probably want to have a fairly good idea of what it looks like. But I think tracking it once a year makes sense. And if it was me, I like to choose the same 3-month period every year. So let's just say, for example, you go February, March, April, and you look at what your costs were over those 3 months and just divide by 3 so that you get a normal monthly amount. And then you do it again next year and you choose the same 3 months, February, March, April, and you look at what your average for those 3 months was. And if you compare that average to last year's average and you start to track it, it starts to give you a very good idea of what your typical cost of living is doing and how it's accelerating. And whatever the national stats are, that's fine. But for you, it becomes relevant to say, if my cost of living is accelerating at 11% a year, for example, and you know that now, you need to make some serious decisions around that. Because, I mean, just to understand, the stock market probably grows at about 12% or 13% a year. So if your cost of living is accelerating almost at the same rate as the stock market is growing, it means you're going to need to invest very carefully and maybe take some serious decisions to control your cost of living acceleration, because you don't want to get to the situation where your cost of living is rising faster than your investments are growing, because then even if you're saving, you're actually losing the value of your money in buying power. So if your buying power is decreasing every single year, and your investments are actually going backwards, you could be in a position where you're really struggling financially in 5 or 10 or 20 years' time, and you feel like you've done nothing wrong. You've been saving every month.
And having a good handle on these numbers is very important. I'm actually looking at a table provided by Stats SA, looking at the compounded annual growth rate of different products that we eat and consume every day. So in 1986, the price of all gold tomato sauce was R1.39. Present day is around 46 Rand. So that compounding effect really hitting those prices. And if you are someone that lived in 1986, you probably wish you were in the period to afford some of these things. I mean, if you look at salad dressing, then was R1.59, Kleenex tissues, R1.45. These days, for one is R22.99, and even higher in some retailers as well. So it's good to prepare for your finances for times when some of these products go up.
And unfortunately, you and I won't get a message on our phone to say, hey, your cost of living's just gone up a lot because you eat tomato sauce and it's jumped up in price by 30%. You won't know that unless you're tracking it. No one's going to tell you. And so and it is a slow poison if you look at the way the cost of living changes, because we might not really pay attention to something like tissues. We just buy them because we need them. You can't just kind of not use a tissue if that's what you're using, and so you'll just buy it. But if it's going up by 15 or 20% a year, I mean, just to understand, if tissues go up by 15% a year, the price is doubling in every 5-year period, and that's really high growth. I mean, that's compounding against you. So it is really important to know that stuff. And you're right, when you look back over a 30-year period or 40-year period, that you start to see how much inflation actually destroys your buying power, and understanding that and being able to take action early on will really help you to make better decisions, number one, but number two, be better prepared for that change of cost of living as you get older and your investments become more and more important.
In conversation with Warren Ingram, the co-founder of Galileo Capital, in our personal finance feature, are telling us how we should be tracking our personal inflation rates and how that will then feed into our investment decisions in order to make sure that we can afford the standard of living. More after this.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.
The Money Show.
Personal Finance with Warren Ingram.
In conversation with Warren Ingram about tracking your personal inflation rate and how that can help you make sure you afford the standard of living to continue affording goods and services, Warren. While other costs increase, your wealth needs to grow at least at inflation or even better. So how can we make sure, as we track our personal inflation rate, we make sure that through our earnings, through our investments, we always have our head above water?
I think once you understand what your cost of living is doing and how it's growing, it allows you to make some clever calls around how your investments are structured. And the most important thing there is, what's the mix of cash, government bonds, property companies, and then most especially shares in the stock market. What is that mix that you need to have so that you can at least track your cost of living change, or hopefully make sure that your investments grow faster than your cost of living? And the thing to understand there is that the stock market has a history of growing the fastest. So it'll track inflation and grow at about 5% a year faster than the national inflation rate. So if we're saying that inflation runs at 6% a year, which is not a bad average for the last decade or two, then you would say, well, the stock market's giving me around that sort of 12% number. And that's really the rocket fuel that allows a portfolio to grow. So even if you don't like the volatility and the roller coaster ride of the stock market, if your cost of living is growing at, let's say, 9% a year, you can't really afford to have too much cash in your portfolio and too many government bonds, because cash, unfortunately, only grows at about 1% a year above inflation. And I'm obviously talking about cash in a fixed deposit or in a money market account. Cash under your bed, unfortunately, doesn't grow at all. And so, cash in government bonds may be around 1 or 2% above inflation. And if your cost of living is growing at 3% a year above, or let's say your cost of living is growing at 9%, you're unfortunately going backwards if you only have cash and government bonds. So it allows you to understand what kind of risk you have to take, how much exposure you have to have in the stock market, and then you can reduce your exposure to the market if your cost of living is growing quite slowly. Alternatively, if you want to build wealth and you want to get to the capital accumulation phase, then understanding that the stock market is your engine of growth, then you're going to try and maximize that and limit your safe assets, which unfortunately don't give you the growth that you need. And I think that's the key decision, why this is so important. That's the thing you really want to understand.
We have a very good question here from one of our listeners, Simon, who's asking, if I have overseas investments, do I need a will overseas? So if I have investments perhaps maybe in Ireland or the UK, do I have to have a will that speaks to their region's regulations around these things?
It is a fantastic question. I agree with you, because the answer, unfortunately, is never simple. So it's not yes or no. It's yes, no, and maybe all at once. There are some countries, so for example, Ireland is one and Switzerland is another, that will recognize a South African will. So if you're a South African citizen, you've got money invested overseas, and you die in South Africa and you've got a will here, then part of your will appoint an executor of your estate. And what will happen then is that the executor will send a copy of your death certificate and that executor's appointment letter to the product providers that you've got overseas where your money's housed, and they will then act on the instructions of your executor as if they were a South African business, because they recognize that. But there are other countries that don't recognize South African executors and a South African will at all, and then if you don't have a will in that country and you die with assets there, it would be the same as if you die without a will at all, and that becomes an almighty mess. So I think it's a very important question to ask, and also one you should check before you invest your money there. The other thing around this is that some countries also charge inheritance taxes or estate duty to non-residents. So, for example, if you've got a bank account in the UK, and a lot of South Africans have a bank account in the UK, they think that that's a great place to store overseas money. Just understand that there is a certain amount of money where, if you've got, and I think it's £325,000 or more, you're going to pay estate duty or death duty on that if you die. Well, you won't, your estate will, and it could be as high as 40%. So then you need to make sure that you're doing some very clever planning, or move your money out of the UK into a region, as we mentioned, like Ireland or Switzerland, where they don't charge those taxes and they do recognize your South African will and letter of executorship.
That was Warren Ingram, of course, dropping gems every Tuesday in our personal finance feature. He's the co-founder of Galileo Capital.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.
Well, that's all we had tonight here on The Money Show. From myself, Tekiso, Tsecho, Peter, and George, it's been a good night. Let's chat money tomorrow.